You earn $1,000 more than you did last year. Maybe it is a little part-time work. Maybe your savings account finally pays something. Maybe your required distribution came in slightly higher because the market was good. Just $1,000. You figure you owe taxes on it at your bracket, and that will be that. Here's what the IRS actually did. They taxed $1,850 of income. The $1,000 you earned, and then $850 more of your Social Security that had been sitting outside the taxable zone, pulled in alongside your extra income like a fish caught in a net you did not know was there. You earned $1,000. The government counted $1,850. No letter came explaining this. No line on your tax return says Torpedo. It happened inside the math, quietly, and unless someone walked you through it, you probably do not know it happened last year or the year before. This is the Social Security tax torpedo. Not a term someone invented to scare you. That is the name tax professionals actually use for this effect. Today, I am going to show you exactly how it works, what triggers it, why that number, 1,850, is not a coincidence, and what you can do so that the extra dollars you earn in retirement get taxed once, the way they should be. Most people think Social Security works one of two ways. Either it is tax-free, or it gets taxed at their bracket. The actual rule is more complicated, and that complexity is where the torpedo lives. The IRS uses a formula to decide how much of your Social Security counts as taxable income each year. The formula has a name: provisional income. Your provisional income is your adjusted gross income plus any tax-exempt interest you earned, plus half of your Social Security benefits. Add those three things up, and you have the number the IRS compares against two thresholds. If you are single and that total comes in below $25,000, your Social Security is untaxed. Between $25,000 and $34,000, up to half of your benefits can become taxable income. Above $34,000, up to 85% of your benefits can be taxed. For married couples, the range is wider: $32,000 to start, $44,000 to hit the upper tier. But the principle is identical. Cross the upper line, and the IRS drags most of your Social Security into your taxable income alongside everything else you earned that year. One thing I want you to hold on to because it matters later. Tax-exempt interest counts in this formula. Municipal bond interest, which many people assume is invisible to the IRS, goes directly into the provisional income calculation. Tax-free in the ordinary sense, but this formula is a separate calculation, and muni interest sits inside it at full weight. Here is where the math becomes the torpedo. You are inside the upper tier, above $34,000 for singles or $44,000 for married. You earn $1 more of income. What happens? The IRS does not just tax that dollar. They add 85 cents of your Social Security to your taxable income alongside it. So your total taxable income went up by $1.85, and they apply your marginal rate to that $1.85. At a 22% bracket, 22% times $1.85 equals 40 7/10 in tax on $1 of extra income. That is a 40.7% effective marginal rate. Your bracket said 22. The torpedo made it 40.7. That is 185% of your nominal rate. Inside the torpedo zone, every extra dollar you earn triggers taxes as though you were in a bracket almost double the one on paper. If you have ever looked at your tax return and felt like the bill was higher than you expected and you could not explain why, this is often the reason.
Now here's the part that sits wrong. Those thresholds, $25,000 and $34,000 for singles, $32,000 and $44,000 for married couples, have not moved since 1993, the year they were written into law, 33 years ago. Everything else moves. Your Social Security benefit gets a cost of living adjustment almost every year. Prices move. Tax brackets are indexed for inflation. But these two thresholds? They are the same nominal dollar amounts they were when a first-class stamp cost 29 cents. When those numbers were set, roughly 20% of Social Security recipients had any of their benefits taxed at all. The original intent was to tax benefits only for higher earners. Today, because the thresholds have never moved while incomes and benefit amounts have grown with inflation, most Social Security recipients have at least some of their benefits taxed. The torpedo zone has expanded steadily, every single year, without any vote, without any announcement, just by standing still while the world moved. Congress could index these thresholds to inflation the way it indexes tax brackets. It has not. In some ways, that is the mechanism. The frozen thresholds raise more revenue every year automatically, without anyone having to pass a tax increase. The people who designed this formula in 1993 did the math. The math has worked exactly as designed.
So what specifically pushes you over the line? Because this is where the torpedo goes from being a chart to being something that lands on your particular return. The most common trigger is a required minimum distribution. Once you reach 73, the IRS requires you to pull money from your traditional IRA or 401k every year, whether you want to or not. That amount counts as income. It counts in provisional income. If it tips you over the threshold, the torpedo fires, and most of the time, no one explains why that year's tax bill came in higher. The second is a Roth conversion. Converting traditional retirement money to Roth is often sound, long-term planning. But the conversion counts as ordinary income the year you do it. If you are already drawing Social Security when you convert, that conversion amount goes straight into your provisional income calculation. The torpedo does not care that the money is moving to a Roth for the future. It cares what happened this calendar year. Third, part-time work. Plenty of people work in retirement, some for income, some for structure, some because they like it. That earned income is provisional income. A few extra shifts a month, if you are already near the upper threshold, can be enough to fire the torpedo. Fourth, capital gains. Sell a property. Trim an appreciated position. Take a gain from a fund that rebalanced internally. Those realized gains feed the provisional income number, and a sale that felt modest can tip the whole calculation. And fifth, I told you to hold this in beat 2, so here it is. Tax-exempt interest from municipal bonds. Many people buy munis precisely to reduce taxes, and they assume that interest is outside the government's view here. It is not. That interest goes into the provisional income formula directly. Buying munis to stay under the torpedo threshold does not accomplish that goal. The formula counts it the same as anything else. So if this effect is real, documented, and has been in the tax code for 33 years, why does it catch careful people by surprise? Because the torpedo does not appear anywhere on your return as the torpedo. There is no line labeled Social Security Tax Multiplier or Provisional Income Surcharge. What you see on Form 1040 is line 6A, your total benefits received, and line 6B, the taxable amount. Line 6B is where the Torpedo's result appears. It is a number. Just a number. Most people see it, accept it, and move on. Your accountant files it correctly because it is correct. The math is not a mistake. It is the law, operating exactly as written. What is missing is the explanation, and no law requires that explanation to appear anywhere you would notice. One more layer. For the 2025 through 2028 tax years, there is a new senior deduction of $6,000 per person over 65 from the bill passed last year. That deduction lowers your taxable income, which means it reduces the tax you owe on whatever Social Security income is already counted. It helps at the margin, but it does not affect your provisional income, which is calculated from your adjusted gross income before that kind of deduction is applied. So the Torpedo still fires at the same thresholds. The new deduction softens the bill after the fact. It does not move the line. Know both pieces.
Here's what actually works. 3 moves. 1 explicit thing that does not. The first, pull living expenses from Roth accounts before your traditional accounts during retirement. Roth withdrawals are not counted as income for federal tax purposes, and they are not counted in the provisional income formula. If you have both a traditional IRA and a Roth IRA, and you need $20,000 this year, pulling it from the Roth instead of the traditional adds nothing to your provisional income. The Torpedo cannot see it. You spend the same money. The second, if you are taking required distributions and you also give to charity, look at qualified charitable distributions, or QCDs. A QCD lets you send money from your IRA directly to a qualified charity, and that amount never enters your adjusted gross income and never enters your provisional income. It satisfies your RMD obligation. It reaches the charity at full value because it goes directly before any tax is applied, and it keeps your provisional income lower than a regular distribution followed by a personal donation would. If you were going to give anyway, a QCD almost always makes more sense. The third move is to run Roth conversions before you claim Social Security, not after. If you are 62 and you have a large traditional IRA, every dollar you convert to Roth now is a dollar that will not sit in your traditional IRA when RMDs begin at 73. A smaller traditional IRA means smaller required distributions, means less provisional income, means less Torpedo exposure for the rest of your life. You pay tax on the conversion now at a rate you control, rather than having the Torpedo add its silent multiplier to every RMD for decades. Now, municipal bonds. I said it twice, and I am saying it a third time because people have been told munis are a tax shelter, and they are not a shelter here. Muni interest is included in the provisional income formula. Buying munis to stay under the Torpedo threshold does not accomplish that. Do not build a strategy on that assumption. Roth withdrawals, QCDs for RMDs, conversions before you claim. Those are the 3 levers. If today was the first time anyone laid out how this works, please like this video and subscribe. The person who is about to take a $20,000 Roth conversion while drawing Social Security and has no idea it is about to fire a 40% effective rate on that money.
They need to see this before they do it, not after. That is the whole reason this channel exists. Here is your one job tonight. 5 minutes, 3 lines on the form. Pull last year's Form 1040. Find line 6A, your total Social Security benefits received. Take half of that number. Find line 11, your adjusted gross income. Find line 2A, your tax-exempt interest. Add all 3 together. That sum is your provisional income. Now compare it to $34,000 if you are single or $44,000 if you are married filing jointly. If you are already over the upper threshold, the torpedo has been firing. Now you know why. If you are under it, you know exactly how much room you have before a conversion, a distribution, or an extra income source starts pulling your Social Security benefits into the taxable zone alongside it. Most people who watch this video have never once run those 3 lines together. You will have done it in 5 minutes, and every income decision you make after tonight will be sharper for it. One final thing. Everything I walked through today is the federal picture. A handful of states still tax Social Security on top of that, with their own thresholds and their own rules. Check your state's treatment too. And for the big moves, a Roth conversion, a large distribution, a property sale, a conversation with a tax professional before you pull the trigger is worth every dollar it costs. What I gave you today is the frame. Your numbers tell you exactly where you stand inside it.